in business. All right, all right, all right. And let's see, is the mic quality good? Okay. Where are we at? Boom. Bada bing. Getting pretty much a lot better at setting up the live stream here. Had a few technical difficulties the first couple times, but we are figuring it out much quicker now. All right. Let's get into it. What do we have from the watch list? Actually, 1 second. Okay, so we got a bounce yesterday. That was from consumer confidence coming in higher than expected, returning to January 2022 levels. Jerome Powell is speaking actually right now. We might need to pull that up. Jerome Powell live. That's from last week. I want the ECB summit. Oh, well, let's just see what these guys have to say. They might. Oh, you're kidding me. I don't want to sign in. I don't know my sign in very much. Can I sign in with my Hulu? Oh, whatever. Really just need to see. Okay, come on now. Okay, I'll find it. I'm committed now. Maybe it's on YouTube somewhere. Jerome Powell live. Aha, there we go. Oh, this guy's still talking? I don't want to hear him talk.
To get this to continue down, because we really want to see this 2.16 get to about 1.6, then we can start pricing in cuts. Let's see what they're saying here, by the way, about why this is so delayed.
Continue to surprise to the upside. And it's been a very long streak of upside surprise. The City Surprise Index is riding above zero for a long stretch this year.
Guys sort of taking a look at the broader market and groups within it. I mean, pharma is not overly weak, but down. But I would note shares of Eli Lilly just continue to power higher of late. They're not up.
Okay. I don't care that much about watching this guy. We can pull him back up later. I don't want to pause that. I want
only
muted. There we go. Okay, looks like we didn't fill that much of the gap down. That's pretty expected. I think this probably would have been a pretty easy move down to catch yesterday. But I did have those puts going into the market close. Didn't end up keeping them. Thought it was a little bit too dicey. And Tesla on the rebound, looking like it's just going straight up. It didn't really get much of the move yesterday, so it would make sense if today it did have a little bit better of a move. Let's see how much these cost. Pretty expensive stuff here from Tesla. Come on, man. Like that's unexpected. Okay, I got a trade, but it's very, very small. Is really all I wanted to do was YOLO a Tesla trade. Luckily, I saw this right when I got on, and it's not typical for me to do this at a very early hour in the morning, but I only spent $100, and I got some 272.5 calls for this Friday. So that's an extremely, extremely sketchy trade. That's why I only spent $100. I'm just gonna wait it out and see if that blows up in my face. Totally fine by me. I'm not gonna post it on the alerts either, because if it does, you know, I don't like posting stuff like that because people will use like 20% of their account and then it'll lose money. And then yeah, they don't blame me, but they just don't. They won't listen. Listen, yeah, listen. Travel stock still going. Which one of these is lagging? Not RCL, that's for sure. Not CCL. I thought CCL was the one that was lagging behind. This could move a lot today. Pack W. Keep in mind we might have Jerome Powell coming on in, well, he will be coming on in just a second. It's just a matter of how hawkish he acts in front of all of his friends. I don't know. It might stay pretty strong. It might not. Got 20% on those Tesla calls already, but like I said, that is a YOLO trade. That is just staying in the portfolio. We're going to see what happens. I'll probably sell some of it today if I can. But, I mean, what we really want to see is it just have a psychotic day like it does sometimes. Buy the dip. It's not much of a dip. It corrected back to 240, which is still almost $1 trillion valuation, so. PayPal, I have puts on PayPal. I have calls on XOM. What the heck? Okay, XOM's on its way down. There's a lot of good oil stuff coming on, but I guess XOM did not want to partake. Got 40% on the Tesla. I guess I think I might sell half the Tesla for 40%. Yeah, I'm going to. It'll be at 66. I paid 47. We're just making it a little bit safer. And yeah, we'll do that. Sell that at 40. Kind of going against the whole YOLO mindset of it, but $50 is enough to just send on out there and into the world and hope that it does something worthwhile. Plus, who knows what J-Pow's about to say. He could be like, hey guys, we're chilling, everything is really, really fun today. Or he could, you know, be kind of a party pooper, which I'm kind of leaning towards the party pooper mentality for J-Pow. He has not been very fun lately. So, oh, the banks need to leverage more. Leverage less. What's up with this? Bitcoin. Ooh. Okay, we're gonna watch this. We want to look at that. Almost exactly 30,000. So Bitcoin is approaching 30,000. If that breaks below it, obviously we want to know. So, okay. What's filling? So what? Why was there two fills? I only wanted to sell one. Okay, it only sold one. Sounded like two to me, but hey, who am I to say? So 30,000 on Bitcoin. Let's set an alert here. I think honestly, if we're just taking a look at this, I would assume that it can go below 30,000 today. Easily. I wouldn't be surprised if it went below 30,000 in the next 20 minutes. Which would bring this down even more. Why is Nvidia down so much? Okay, they're coming back. Tesla's still only up 1.7%. So there's could be theoretically a lot of room there. Not all the way up to here. I don't expect that at all. But I wouldn't be surprised if it got up here somewhere closer to 260. Because this day, it even tried to rally here. So we had a little attempted rally, came straight up, and then that day it did end up going absolutely bonkers straight down. And then yesterday got this little bit of a bounce after the consumer confidence news, and then today we're pretty much doing the same thing we've been doing every morning, which is going straight up. But only sometimes does it continue. So that's why we sold half them. It's kind of a crazy one though, so, and it's not going to help if SPY is going the freaking wrong way too. So we'll keep an eye on that. I do want to hear Jerome Powell once he comes on. Oh, here he is. What's up,
to
bro?
go to that. It may work out that way. It may not work out that way, but I wouldn't take, moving at consecutive meetings off the table at all.
I'm trying. Governor Ueda, I mean, first of all, it's great to talk to you. We haven't heard much from you outside of your policy meetings in Japan. I think the world wants to know why you're the global outlier here. You have decided to maintain your easier monetary policy in the face of rising inflation. Why?
So a simple answer would be, although the headline rate of inflation is above 3%, which is well above the 2% inflation target, we think underlying inflation is still a bit lower than 2%. That's why we are keeping policy unchanged at the moment.
Even though we've seen measures, including core, right, higher than the 2%
the union
level.
core is also above 2%. But let's say, let's look at the rate of increasing wages, which is an important determinant of inflation. It has risen, but is now running at around 2%. Now, if you want a 2% inflation rate, wage inflation that's consistent with that would be slightly or well above 2% if you assume productivity growth rate is positive. So there's still some distance to go, we think.
And as a result of your policy being different than all these policies of your colleagues, the yen has gotten very weak and continues to weaken by the minute. Is it too weak?
Well, the yen is being influenced by many factors other than our monetary policy, including the policies of these three banks. So we'll see. We monitor the situation very carefully.
Monitoring the situation
Yeah.
for intervention purposes.
No, it's the jurisdiction of the Ministry of Finance. Decisions on intervention.
President
Forex
Lagarde,
policy.
President Lagarde, how much would you like to see inflation moderate from these levels? Because we've already seen a nice moderation for you to feel comfortable taking a pause or potentially going the other way.
Well, this
Going
is
the other
not
way.
what we're considering at the moment, okay? But if I look back at what we've covered, inflation was, I think the highest reading we had was 10.3. We are now at 6.1 headline. Core has moved a bit down, but we are really looking at both headlines, which is the measurement that we have agreed in our strategy and that is visible for people, for the consumers of Europe, but we're also looking at underlying inflation. And on that front, we are not seeing enough tangible evidence of the fact that underlying inflation, particularly the domestic prices, are stabilizing and moving down. So we're looking at as many measurements as we can because we want to be in sufficiently restrictive territory for long enough so that we are confident that we reach our 2% medium-term target.
That's a buzzword.
Why is it so sticky, Governor Bailey? And why is your inflation rate higher than that of Europe's?
Well, let me distinguish headline and core for a moment. So with headline inflation, I do expect it to come down markedly this year. As
The world central bankers in Portugal talking to our Sarah Eisen. What a textbook.
Don't do that. Hold on, I will get coverage of it. 1 second.
Around the world. As for the U.S. interests, Powell with a great joke about how it's neither a pause nor a skip. But
All right, this one's only a little delayed, but we'll jump in over here and listen to it.
And that is visible.
Oh, but this is the crap one, audio.
We're also looking at underlying inflation. And on that front,
Hold on. We'll get to the bottom of this. This is
level
annoying.
of rates or near this level of rates is restrictive enough, and that more than moving every meeting to tighten further should do the job. And the ECB, of course, data dependent. That's the message there.
interesting. We'll see. I mean, I'm sure Sarah will eventually get to how policy decisions have affected various decision cycles, particularly in the UK, where Brexit continues to get a lot of discussion of how it altered the labor market, for one thing.
Without a doubt.
Let's try this one. Hold on. This is directly with the ECB.
So we have had a shrinkage of the labour force. We're seeing some reversal of that now, but we're still not back to where we were pre-COVID. So that is causing the position in the labour market to be very tight. And I see this when I go around the country talking to firms, because what they say to me very frequently is that their plan is to retain labour as much as they can, even in the event of a downturn, because they've been concerned and it's been difficult to recruit labour. So that's certainly taking place. So I would say there's a backdrop of a very tight labour market.
Okay, so we're coming down.
Is it Brexit related also?
I don't know if it's.
I don't think Brexit is a part of that labour market story. I think a lot more of it is actually to do with, frankly, the response to COVID. I mean, we've seen people. The UK is a little unusual in this respect. We saw people come out of the labour force during the COVID period. Other countries have tended to see that position reverse more quickly and more strongly than we've seen in the UK.
Governor Ueda, when it comes to the inflation path for you, I mean, I know you'd like to see it continue to rise from here, right? What would it take for you to really strongly consider abandoning the yield curve control and negative rates?
So we have a forecast or a projection of inflation path that looks like it's going to go down for a while toward the end of this year on declines in import prices, and it's spilled over to domestic prices. And from there on, we are forecasting some increase in the rate of inflation into 24. But we are less confident about the second part.
If J-POW doesn't talk, then we're just going to keep going up.
If we become reasonably sure that the second part is going to happen, that could be a good reason for a policy change.
If you see a steady increase?
If we are reasonably sure that the second part of the forecast is going to.
But didn't you learn from these three that inflation turned out to be not transitory?
Excuse me?
I mean, wasn't one of the lessons from the last year that inflation wasn't transitory and that there are some
Was
elements
not.
in it, was not, and that there are some elements of it that are sticking and proving difficult to fight?
Right. So the second part is the sticky part, but it's still, as I said, we think
Okay, we're
less
still
than
going up. I have
2%.
those Tesla calls.
We hope
Those
to
are up
make sure that it's
65%
going to go
now.
up to 2%.
I'm keeping those as kind of,
Chair Powell, we've
I
seen
have
some
the,
progress in the U.S.
I have the Tesla calls that are up 60 something %, and then the puts as well. So I'm kind of playing both sides of this right now, and then I'm gonna sell at least one side. Well, it's probably just gonna be the Tesla calls if Jay Powell keeps being a party pooper on this whole parade where everyone else is kind of happy, and then he's like, but. So I don't know. We'll see.
It's
what he
months
says.
now.
Everyone else is pretty positive. I think they're a little falsely positive, but that's okay.
Also because consumption is moving back
Oh.
to services and away from
Here's Jay
goods. So
Powell.
that part of the story makes sense. Housing services is the next piece, and between that and goods, you have a little bit less than half of the total index. And you see now the new rents that are coming in are at lower increases or no increase, and so there's significant disinflation in the pipeline there, but it's going to take 12 months or 18 months to get there. The place where we haven't really seen much progress is in non-housing services, which is a little more than half of our
Wait, I
core
wanna cancel
PCE
that order.
inflation index, and that's
Cancel.
hot hotel services, travel services, food service, financial services, healthcare, those things. It's a very generally very labor intensive. Some of it's quite cyclically sensitive, but some of it's not. The point is, we really that's where we're not seeing a lot of progress yet, and the reason is that, or one explanation for it is that labor costs are really the biggest factor by far in most parts of that sector, and so what we need to see, we've seen a lot of signs of softening in the labor market, but it's just kind of beginning. We need to see a better alignment of supply and demand in the labor market and see more softening in labor market conditions so that inflationary pressures in that sector can also begin to subside.
Are you surprised that hasn't happened yet after 500 basis points of tightening already in a little over a year?
Yes, I think widely it's been surprising that inflation has been this persistent, but I think the bottom line is that policy hasn't been restrictive enough for long enough to start to see those effects. And the service sector is not especially interest rate sensitive, by the way, as opposed to, for example, the goods sector. So we wouldn't expect it to be the first to be affected, but we would ultimately expect, as demand softens and as the labor market conditions go more into balance between supply and demand, we would expect to see inflationary pressures subside in that sector as well.
Do you guys coordinate? Do you talk amongst yourselves?
Yeah, of course we do.
I mean, do you call before policy meetings?
Can I
Yeah,
just,
please.
I just want to follow up on what Jay said, because I think he's completely right. And I think that this is what I call the catch-22 issue, where we have an expected catch down where manufacturing eventually will align, or services will align on manufacturing. And that would be the logical consequence of the lag time that it takes for services to align with manufacturing and to, see prices go down in that sector. The catch up is that of labor, because it is, as Jay said, labor intensive. It's generally relatively low productivity and low skilled jobs in those sectors, and also those jobs that are going to seek the catching up with pre-COVID times. And how that catch down, catch up will be resolved is going to be critically important for where inflation is heading. Because if we see inflation going down in that service sector and movement of wages while increasing at a moderate pace, then we would be in a relatively good place. But that is totally question mark for the moment.
Yeah, it sort of raises the question, Chair Powell, about whether we need to see a much higher unemployment rate in the U.S., and you're all dealing with a tight labor market, to finally really break inflation.
So, that the way we think about that is that there seems to be a path still for labor market conditions to soften and for demand and supply to get back into balance without the kind of large job losses that have happened in many prior cycles. And the reason for that is the level of job openings that still exist in the labor market. So it's still set 1.7 job openings for every person who counts as unemployed. That has been coming down. It's actually, the number of job openings has come down now by almost 2 million. And what you're seeing is wage pressures. They're still high, but they're definitely coming down. You're seeing surveys of workers and businesses suggest that the labor market is not as tight as it was a year or two ago. So you're seeing a job creation is beginning to come down. There are a number of indicia that would suggest that we're getting the softening that we need. We're getting it slower than we'd expected, but nonetheless, it's happening. So it's still a possibility there. But it's so uncertain right now. In my view, the least unlikely case is that we do find our way to better balance without a really severe downturn. I think there's a significant probability that there will be a downturn as well, though. But it's not to me the most likely case.
The least unlikely.
That's the hard landing scenario.
Or just I wasn't even thinking of hard landing. I was thinking of even a recession. To me, it's not the most likely case, but it's certainly possible. And of course, many forecasters do predict that.
Is Europe in recession, President Lagarde? I mean, we've seen 2 negative quarters of GDP. I don't know how you define it. But
I think the first quarter of 23 was actually completely flat, wasn't negative. So technically, I think you could argue that we did not see a recession, but it's stagnant, to say the least. And the expectations for Q2, particularly in the industrial sector, if I look at PMI numbers, are not giving us great hope that there will be a strong recovery. We see a second half of 23 up from the first half, certainly, but moderate. We have a 0.9 forecast for the whole year.
do you agree with Chair Powell? Do you think you can get away with this tightening cycle without dragging Europe into recession?
Our baseline does not include a recession, but it's part of the risk out there.
Are you willing to tolerate a recession?
Well, the interesting thing for us is that if you go back to last November, when we did a forecast, we were predicting quite a long but quite shallow recession. And the economy, as I said earlier, has turned out to be much more resilient so far. Now, I think you can sort of point to a number of things that underlie that. One of the things I would point to is the fact that we've had a very sharp fall in energy prices in Europe. And that obviously has helped with the whole question of the terms of trade shock that we've been having. It's done quite a bit to reverse that terms of trade shock, and that feeds through into national income. So I'm not surprised that we've had this reversal in one sense. What was surprising, but actually very helpful, was that, of course, we did have this big fall in energy prices and a much better winter, frankly, than we thought we would have. So, we're going through this year now in a more resilient position than I expected. So we're not currently forecasting it, but obviously we have to watch it very carefully.
How's the Japanese economy faring? I mean, it's very exciting if you look at the Japanese stock market at a 30-decade high. What's happening fundamentally?
It's doing fairly well. I mean,
Stonks up, boys.
contribution from some inventory investment. Domestic economy is expanding at a pace slightly above potential, I think, driven by pent-up demand. We relaxed pandemic-related restrictions in May, and this is stimulating consumption and investment.
Okay.
There's also green GX, DX-related business fixed investment taking place. So investment is fairly strong at the moment, we think.
Keep in mind, this guy just took over as the 32nd governor of the Bank of Japan in April.
But there's, of course, a lot of uncertainties going forward, including what may happen in Europe and the United States.
I asked if you guys coordinated or talked about monetary policy before. I mean, does that happen? Should it be more coordinated? Because you're all doing different things right now.
Well, I mean, I'll start. I mean, obviously what we don't do is say, what should we do, what should you do? Because we're all setting monetary policy for our areas, and that's the law in all of our areas, actually, so we don't do that. But we do talk a lot, and I think it's important. I mean, it's important at all times, but it's particularly important in recent times at the moment because we're facing such big global shocks. We've got common shocks. They differ a little bit in terms of their impact and their effect, but there's some huge global events going on that are affecting all of us. So, I think we do talk quite a lot and we see each other quite a bit because it's important we do that. And, we share wisdom on how we're sort of interpreting the things that are going on around us.
I guess
I think Jerome
we
says
are
this guy.
in a flexible exchange rate world, so we do policies independently. But of course, we exchange information, which is very, very valuable.
Do you think that, Governor Ueda, do you think that they are over-tightening?
No.
No, you don't. You approve of the policy. You've had a very tight labor market for a long time in Japan, even before COVID.
Yes.
Demographic issues there,
Demographics
yeah.
is working in a way to tighten the labor market for quite a long while. And it's going to continue this way for a while.
All right,
I mean,
these
the
guys are
economic
annoying me.
conversation